So you clicked on this video because you have a 401k, an IRA, or other forms of a tax-deferred retirement accounts, which is awesome, but there's some things that your company, your custodial company, doesn't want you to know. Because if you knew what they don't want you to know, not only will you change your investment philosophy and allow you to make more money, but of course they lose a customer. So what's the information or the secret that they don't want you to know? And whether you have your own custodial company that you chose to use, or maybe your employer provided one for you, I'm not saying that they're evil or bad, but they're not telling you certain information because, well, who would actually want to share stuff that would make them lose customers? And the best analogy I can give you as a metaphor to kind of prepare you for what I'm about to share is imagine going into a restaurant and you're handed a menu, and really all you see are 3 things on the menu, but secretly there's actually 20 more things that they offer and they're not telling you about it for some reason. And maybe it's because those other 20 items don't make them a lot of money, but these 3 items do, so they only tell you about the 3 things. And that might be what's going on with your 401k or an IRA, whatever tax-deferred qualified plans that you might have. So let me share exactly what I mean. So to articulate this clearly, I'm gonna go and use my digital whiteboard to show you how your 401k or an IRA may have been set up by your custodian or your employer to basically make you money. So let's just say this bubble right here represents your 401k, and whether you have this through an employer or maybe you initiated yourself to set up a 401k, a Roth IRA, whatever the case might be. So let's say every year you're making your contributions and you have your employer matching you, which is awesome. Which, by the way, if you have a scenario where your employer is willing to match your contribution to your 401k or an IRA, I would definitely take it because it's a great deal. It's a great way to enhance your retirement savings, your investments over time. Definitely should take it if your employer offers it. So your contribution goes into your 401k, and it's not the 401k that's making the money, but what you're investing inside of your 401k. And I know sometimes when we have conversations, you may say, as a figure of speech, you're investing in your 401k. What you're technically doing is you're investing in certain commodities, assets, investments within your 401k. Your 401k is just a tax-deferred account, like a checking account or a savings account that pretty much has a special tax treatment. So your custodian, which is the company or the institution that's administering or offering your 401k, I won't name any names here, but those big companies that are out there that offer you 401k accounts or IRA accounts, what they do is basically they give you the menu to say, hey, Mr. or Mrs. Investor, here you have different options such as you can invest in individual stocks, you can go and invest in bonds, ETFs, mutual funds, and certain commodities. There we go. So stocks, bonds, ETF, mutual funds, commodities, you name it. And a lot of times they may have like a self-serve portal where you can go and pick and choose which investments you want. Maybe you want to invest in a certain stock. Maybe you want to invest in a certain index fund. They give you kind of a self-service tool. Now, that's great. And a lot of times, these custodian companies may have their own product. What I mean by their own product is they may have, let's just say the custodian company is called Sam Kwok Mutual, right? Or the Kwok Brothers Mutual. They'll essentially have their own mutual fund or index fund product that's branded for them. And they might give you some projections and data such as this, Sam Kwok mutual fund performs historically at about 6%. Okay, so they sell you certain mutual funds, ETFs, and whenever they do, they make money. Plus, they get what's called a management fee. So whatever you have as a principal balance or contribution into your 401k, they may charge you anywhere between 0.5 to 1% as a management cost on your entire portfolio to basically help you manage your money, and obviously cost them to administer, offer you these technologies, right? Certain apps that they may give you to pick and choose your bonds and stocks and so on. Now, what ends up happening is when you invest in, let's say, Sam Kwok Mutual, it might be pegged to or tied to the S&P 500. It might be tied to a specific index, and maybe it's a pool or a collection of different stocks that they picked, like a tech industry or healthcare industry. They pull them all together so that you're not winning or losing money based on one specific stock or one specific company, but it's more of the industry. And obviously, there's less risk of investing into an entire industry as opposed to just investing in one specific company. And what ends up happening is when you invest into these mutual funds and ETFs, which are great, nothing wrong with that, your money then essentially is being used to fund businesses, projects, real estate deals, and so forth. So what ends up happening is when you put $1 into a mutual fund or an ETF, that's ultimately being invested across multiple companies, and basically they take that money and invest into businesses, expand their businesses, expanding into real estate, making great profits. But the reality is that many of these businesses and real estate projects they do and all the companies are invested within the mutual fund, they might be the ones that get most of the profits, most of the dividend shares, most of the return, and you basically get a little bit of the scraps. Now, I'm not saying that's true for every investment. I'm not putting a blanket broad statement over it. But if I'm being specific, let's say you invest in something called a REIT, which is a real estate investment trust. And maybe real estate is something that you believe in, you want to invest in real estate. But what ends up happening is that when you invest in a REIT through your 401k, that money is being used to do real estate deals, buy multifamily, buy apartments, buy commercial real estate. And the REIT companies themselves, their performance might be 20, 30, 40% return on that money. But really what they're giving you is a small fraction or small bits of that instead of the entire return that they're getting. Now, here's what I'm getting at. Instead of relying on a third-party custodial company, and instead of relying on big businesses and REITs and mutual funds, which are all great forms of investments, by the way, there is an alternative of, instead of relying on the third party or the middleman, what does it look like for you to basically participate in what these companies are doing? You basically get to participate in the larger share of the return, the profits, rather than just getting the scraps. So to cut the middleman of the custodian or the mutual fund or ETF, which again, all great investments, if you want to be able to cut the middleman and you want to reap the benefit of directly engaging in these business and real estate investment activities, I'm going to show you how, and that's through something called the self-directed retirement plan. Now, some of you guys already are familiar with this, such as self-directed IRA or solo 401k, self-directed 401k. There's even self-directed HSA, a health savings account. But a self-directed retirement plan is something that most of you may not have heard of. I'm going to introduce it to you guys right now and how it can be used to cut the middleman out and engage in larger returns potentially. So I'm gonna go ahead and erase this. So if you already have a 401k or maybe you had one with a previous employer, you can do what's called a rollover. So here's your traditional 401k, but this can be rolled over, all right, there we go, a little swirly for the roll, to something called a self-directed IRA. Now, do you remember the analogy, the metaphor I gave you about walking to the restaurant and only seeing 3 items in the menu when there's really 20? Well, the self-directed IRA does exactly that. The IRS allows you to invest in most things that hold value. So for example, using your self-directed IRA or a self-directed 401k, you can invest into private companies. You can actually loan money out of the IRA or the 401k. You can invest in crypto, invest in commodity, and you can still, if you like, to invest in mutual funds, ETFs, stocks, bonds, treasuries, you name it. But the menu opens up to not just your traditional forms of investments like stocks, bonds, and mutual funds, but you can invest in things like real estate, like actual real estate deal, not going through a REIT or a third party. You can invest in private companies. You can invest in loans or issuing loans or promissory notes. I've done that before. Invest in crypto if that's your cup of tea, right? You can also invest in commodities and precious metals. There we go. So it opens up a wide variety of things you can do that is pretty much allowable by the IRS. I actually know a few people that do some really untraditional, unorthodox things, such as they use their self-directed IRA to go purchase Super Bowl tickets, and then they will later resell it at a higher markup, 20, 30%. And boom, that's their 20 to 30% increase in their self-directed IRA, tax deferred, which is really cool. And they love sports, so it meets kind of their cup of tea. But please speak to your CPA, your tax attorneys, as well as maybe custodians, because this is something that is available not to the elites, not to the 1%. It is available to all Americans that participate in the economy. And if you have a job, if you have a business, you can get a self-directed IRA or a self-directed 401k. It gives you more options, which is what I'm saying. So what about all this is cutting out the middleman? Well, remember I told you when you invest into a mutual fund, an ETF, or an index fund, what ends up really happening is that money flows into a business and business grows their value and launches new products, or maybe they're investing into a real estate project. They might be looking at a 20, 30, 40% growth on their books, on their profit, but you only get a small share of that. Well, what if you could invest maybe into a private company in your area that you have a good, firm educational understanding on what that is, and use your self-directed IRA to do so? So I'll give you an example. So let's say down the street, you know, a very good friend of yours that's doing really well right now in their business. They're growing 20, 30, 40% every single year. They're rocking it. You know, it's an ice cream store, let's just say. And you would think you can't use your self-directed IRA to invest in their company, right? Nope. You can actually, as long as they're willing, your friend, if they're looking for more investments, your self-directed IRA can invest into private companies such as an LLC, a corporation, a S corporation, invest in that private company and take equity ownership of that company, and any profits, distributions, and growth of that company, basically your self-directed IRA or self-directed 401k gets direct benefit from your buddy's company growing 20, 30, 40% of the time. And the difference is you're not investing in a public company that anyone can go and buy stocks at a New York Stock Exchange. You basically having a relationship with a private company can invest in their company and reap the benefits of that as well. That's basically Wall Street, guys. Wall Street's job is to go and get public companies and allowing you to buy shares and buy bonds whenever the bonds are issued. You can cut out the middleman and get into private deals and potentially experience double-digit returns and returns that exceed whatever the market, the public market, might be getting. So you can get into private companies, you can get into real estate deals, yes. If you've always wanted to invest in real estate, apartments, Airbnbs, single-family rentals, you can use your self-directed retirement plan to invest in real estate deals. Yes, it's possible. And a lot of my clients are shocked that they can do this, which is kind of interesting. So that's what I wanted to show you, and what most custodian companies, whoever you have your 401k or an IRA through, they don't necessarily want you to know this stuff because, again, maybe you do want to get into real estate, or maybe you do want to invest in private companies. And the moment you decide to take the money from your 401k and roll it over to a self-directed account, they lose business and they lose money, that 0.5% or 1% management fee. Now, are there certain risks that come with getting a self-directed IRA or 401k? Absolutely, right? You better know how to invest into a private company. You better know and understand real estate. And obviously, the more educated you are and you increase your intellectual capacity of understanding different investments, you will most likely be able to profit and generate more profit over time and beat the market, essentially, if obviously you possess specialized knowledge and so forth. So this is why, even if you think you're not financially savvy, that you don't know much about investments, to learn something, pick a subject or pick an investment that best suits your lifestyle, that best suits your interest, whether it's real estate, maybe it's crypto, maybe you want to get into a lending type of business, or maybe there are certain types of private companies that you know, friend or otherwise, that you want to invest in and you understand it really, really well. So this allows you guys to be able to maximize your options. And I'm not saying this is the end all be all. If you love your 401k account, then stick with it. Talk to professionals about it. But this is an alternative option that you can look into and do some research. Talk to professionals, CPAs, attorneys that are educated in this subject, and get more educated. Watch other YouTube videos. It doesn't have to be our videos here, but it's definitely something that I'm passionate about sharing and even documenting my journey of how I'm increasing and learning my wealth and the mistakes that I'm making so that you don't have to make yours. So guys, the point of this video isn't to get you to switch to a self-directed retirement plan. Again, if you love your 401k, great. But I just want you to know that there are options to be explored, for you to learn, for you to expand. My message is that the more that you're educated, the more that you're informed, I believe that you'll make better decisions financially, and that's what I'm all about. So again, speak to professionals, CPAs, attorneys that know more than I do, quite frankly. But if you are wanting to maybe switch to a self-directed 401k or an IRA, I'm gonna leave a link down below where you can talk to professionals and get free consultations from certified and licensed individuals to learn more about it. You can go and talk to them down below in this link. If you're brand new to us, I hope you join us in our journey, and as we share together, subscribe, like the video, and leave your comments down below. Let me know what you think, because every feedback we use to make more videos and answer questions that you guys may have. So with that said, check out this video right here where we share more about financial literacy, helping you make more money and keep more of it. With that said, see you in that video.